or Seha, I'm so sorry.
It's a long A. So say hi.
There's a long N?
A.
Oh, thank you.
Thank you.
Seha, okay,
Yeah, present.
thank you. Ms. Yamamoto?
Here.
Ms. Dillon?
Yeah.
Ms. Hendricks? And, let's see, representing the Director of Finance, Ms. Wong Hernandez? Chairperson Paquin, you have a quorum.
Thank you very much. Do I have a motion to approve the committee agenda?
Second.
Thank you. It's been moved and seconded. All those in favor say aye. Looks like the motion passes. And are there any comments on the minutes from the May 10th, 2018 Board Governance Committee meeting? Any changes? Do I have a motion to approve the minutes? This motion's been moved and seconded. All those in favor say aye. Any opposed? Motion carries. So this brings us to item number 3 in our annual fiduciary training with our fiduciary counsel, Harvey Liederman. Welcome. I'm looking forward to it.
Thank you, Madam Chair, and thank you all. Friday afternoon on my favorite subject. How can I make it yours? But thank you. Before I begin our topic for this afternoon, I wanted to take a moment to introduce you to my partner, Jenny Krangle. Jenny and her partner, Don Wellington, had been with the Steptoe and Johnson firm for a number of years. Jenny actually comes out of CalPERS legal department, but they joined our firm, Reed Smith, this spring. And Jenny and Don have done a lot of tax work for CalSTRS in the past, and are working with me on fiduciary matters as well. So I just thank you for letting me introduce Jenny to you. You may be seeing more of her.
Thanks for having me.
As well. So annual fiduciary education. This is sort of the time when we can take a step back a little bit from the issues that occupy us every single day. And Lord knows this week we've had a lot of them that have triggered a lot of fiduciary interests as well. But it's a chance for me to take you back a little bit to 36,000 foot view. And then normally what I like to do is take one of the subject matters that have been occupying the board's attention for the last several months and use that as a vehicle for looking at things through the fiduciary lens and see how we can reorient ourselves on all things fiduciary through that vehicle. With your permission, what I'd like to do with you today is just start again with the fundamental fiduciary duties to kind of orient you to the issues that we'll be talking about and why you should care about that, why you should care about identifying your fiduciary responsibilities. I've had the opportunity to work with the board now for several years. I want to just identify some of the targeted topics that we've talked about in the last couple of years and what we're going to talk about today. Today, I want to use as the vehicle for the conversation this collaborative model that was brought to you by Ashby Monk from the Stanford Global Project Center. And then talk a little bit about the fiduciary issues that model raises, which I find fascinating. And then segue a little bit into how that model is being adapted and adopted by the investment division and the investment committee, how it differs and how it moves, in my view, closer to a fiduciary fiduciarily responsible application and does not get hung up in some of the real problems that the academic collaborative model would pose for a public pension fund. So that's what I have in mind. If you have any questions or things, let's just make this interactive and see if we can work through the issues in the time that we have on the subject. Let's just go back to fundamental fiduciary duties. I've put these before you before. We're going to be coming back to these throughout the next 30, 40 minutes or so. You're aware of them, the exclusive benefit rule. This is just the absolute, frankly, it simplifies your job. If you just keep in mind that you have one solitary responsibility, which is delivering in a timely manner the promised benefits to your members, and to do it for a reasonable expense. That's it. That's simple. We don't even need annual training for that. But that's really the focal point of everything that you do. Use the plan assets solely for the purpose of paying those benefits and reasonable administrative expenses. That is because you have a primary loyalty to all the members of the system. This is a little bit more difficult because when we look at the idea of loyalty to the members of the system, you look at who are the members of the system, and we have a wide variety of people who count on this system both today and tomorrow for their benefits. We have active members, we have retired members, we have deferred members, we have members that come in and out of service. One of the most difficult things that you face is how to balance those interests of all the members, because there are times when the interests of active members depart from the interests of retired members, and how do you reconcile that? That is one of the most difficult balancing acts a public retirement board has to engage in. The prudent expert standard is really the how you go about your business. In one of my previous sessions with you on this topic, we drilled into, I think I gave you a number of cases, actual cases that had come up around the country of pension fund trustees being sued for breach of fiduciary duty. And they always came down, every single one of those cases came to the issue of process, not results. Did the board act prudently in the process that it went through in making its decision? Because you are held to a higher standard than just simply being a prudent person. You're held to a standard of somebody, the language in the third line there, someone familiar with these matters. That's why you have to educate yourselves. You have to engage in a due diligence process, and when you don't have the expertise, you have to go out and get it. Because you're held to the standard of somebody making decisions on behalf of the membership with knowledge, not just with a good heart. So the care and the skill that you exercise in a prudent process is what determines whether you're satisfying your fiduciary responsibility, not whether you get it right or wrong in the end. Not whether in 2020 hindsight, 5 years from now, we can say something like the RMS strategy was a good strategy or was not a good strategy. But at the time you implemented RMS, and at the time you continue to monitor and see how it performs, under the circumstances then prevailing is the phrase, did you engage in a prudent process to bring you to that decision? That's really what that's about. The next fundamental duty is diversification. The people of California long ago decided that modern portfolio theory was going to be the underpinning of our public pension funds. The idea of a diversified portfolio spread out along what's come to be called the efficient frontier, which balances risk and reward, and the board's responsibility is not to put chips all in on one bet, but to diversify across all aspects of public and private markets, and to do so with a risk and return profile that you're comfortable with. So this is written into the law. This is basically a fundamental fiduciary responsibility under California law. It's in the Constitution, it's in the Education Code, it's in your investment policy statement. This is an obligation of the board. It also puts a constraint on you for overloading certain asset classes, unless it's clearly prudent to do that. And so you look at your portfolio and you're constantly making decisions about the benefits of diversification, particularly, again, I'll come back to under the circumstances then prevailing. We had a lot of talk yesterday, I think it was, or possibly, I guess it was Wednesday during the investment committee, where we were talking about a mature system. And from the actuarial discussion yesterday as well, the conversation that we are a mature system. We're in a cash flow negative. We pay out more in benefits than we take in contributions. This is all part of that, the idea of diversifying the portfolio so that you have both liquidity to pay benefits and growth opportunities to earn the return that you need to pay in the future. So the final fiduciary duty that often goes unstated is a recognition that we owe our existence essentially to the Internal Revenue Code. I mean, the whole premise of this pension fund is its qualification as a tax-exempt, a tax-deferred organization so that the earnings are not taxed to the members, and the members may deduct their contributions. So the IRS requires us to follow our plan documents. That's why we spend an enormous amount of time dealing with issues of what goes in our plan documents, what goes in our policies, and Jenny works on that all the time. Because we are a tax-qualified fund, it is absolutely essential in terms of maintaining that qualification that we adhere to our plan documents. Why do we care about these precepts of fiduciary responsibility? Yeah, I see it as I observe what the board does every day during the board meetings and committee meetings. I watch you try to stay inside the chalk lines, and you do stay inside the chalk lines. Chalk lines are there to give you direction, and virtually every decision that we make, whether it's the funding of the benefits or the asset allocation, even we've had the constant discussion about the Pension Solutions Project. Well, there's a good example. What is the purpose of the Pension Solutions Project? It's to help us timely deliver benefits accurately to our members and their beneficiaries. It's part of the prudent administration of the system. It's part of the obligation to expend only reasonable expenses of administration. We went through the same conversation, whether you were aware of it or not, yesterday when we talked about the building project. Is that a reasonable expense of administering this plan, and why is it a reasonable expense? Talk about a prudent process. The process that this board went through and continues to go through on the building project is a perfect example of the high level of expertise and diligence that is expected of the board when making a decision of that consequence. The data that was gathered, the outside expertise that was made available to you, the if-then discussion. What do we do? Do we lease? Do we buy? Do we lease it and sell back? What do we do with this building? All those conversations led to a prudent decision-making process, but it also had a great deal to do with whether or not we were administering the fund only, and costing only reasonable expenses of administration. And that goes back to the first precept about the exclusive use of the assets of the system. So it raises issues about delegation and monitoring of our responsibilities. These are all the aspects of where the fundamental fiduciary responsibilities come into play. Even in the public policy realm, where we have policies that say if legislation is pending that will have an impact on the administration of our system or our members' benefits, we take an active role in those things. So that is part of the prudent exercise of administering the system, keeping the members' interests first and foremost. Like I say, I like to have this conversation not in a vacuum, but I like to identify topics that are before you and use those as kind of the conversation vehicle. So that's what I'm going to do today. In the past, we talked in much more detail about balancing the interests of various constituencies of members. A couple of years ago, I used ESG and our policies on ESG and the risk factors as a way to try to have the conversation as to what are your fiduciary responsibilities. You know, we've had constant discussions about do we need to have something that demonstrates an actual impact, economic impact on the system, or can we take positions that may not have a predictable economic impact on the system, but for other reasons, the board believes that it's appropriate to take a position on an environmental or a social or a corporate governance issue. Last year, I got into more detail with you about some examples, as I mentioned, about how do boards get into trouble. When are they sued for breach of fiduciary duty and why? And so we talked a lot about process in those specific situations. So today what I would like to do is talk about this collaborative model and the fiduciary responsibilities and considerations that arise out of it. I noticed in the business plan from the investment branch a couple months ago, banner, headline, this year's theme is developing the CalSTRS collaborative model. So I figure this is probably pretty timely. You can blame this guy who came here in February. Ashby has come forward with, in a lot of venues, with a conversation about this model that is being discussed. It came out of this, documented in the book, Reframing Finance, that he and his colleagues have put together. I think you all got copies of it. I don't know, were they autographed? You got yours as autographed? I don't know if that'll add the value on eBay or not, but this is, I figure this is a timely theme to talk about. This collaborative model has academic underpinnings, and I think it's academic seeking practical application. It's the next genesis of investment models. Long time ago, there was the Norwegian model, and that model was basically, you know, the investments were all in public markets. Then the Yale endowment model came along, and that said, well, we can enhance our returns by going into private equity and using external managers to accomplish that. So that was the next iteration of that. After the Yale endowment model, the Canadian model came into vogue. And that model says, well, wait a minute, now we can go heavily into private equity, but we can do it through in-house expertise. We can develop this talent in-house, and that has held sway, and that's been very persuasive. It's been very persuasive with our investment branch, to be sure. We can make direct investments into private markets, both equity and debt. And so that, Ontario Teachers is a good embodiment of the Canadian model. Well, it's been a few years since the Canadian model's been in place. And so, just as General Mills repackages cereal, people start looking at different ways of accomplishing and improving on the models. And this new model, this collaborative model, takes a look at the Canadian model and says, frankly, that's too expensive. It's too expensive to continue to use external managers to run money when we can fully develop in-house expertise and take advantage of the expertise that peer investors have across the board. In other words, we can collaborate together to achieve an investment goal of effective investing at a lower cost than we would if we had external managers the way we do now in private equity and private debt. I've put forth a number of quotes here from what's the name of the book again? Redefining Finance, Reframing Finance, yeah. So you can get a feel for what it's really talking about. The idea is essentially to knit together a patchwork of like-minded investors, public investors, sovereign wealth investors, endowment investors, tap their internal strengths and develop a network of trust, what's called club investing in the book. And by taking advantage of those qualities of the investors, disintermediate the current method of accessing private markets. In other words, cut the managers out. Take advantage of the manager's expertise, but cut them out. So you see some of these quotes. These are vehicles intended to provide more alignment for investors. It draws on social network theory. Paul Shantic, I think, at this last meeting called it, social capital in the materials. Let institutional investors develop their own internal expertise and form deep, trusting relationships with potential partners. Take advantage of being independent of external fund managers, all based on this idea that we can be one big club of peer investors and take advantage of our strengths for the benefit of all. So, what are the strengths that they target? They say this would really work best in private markets, private equity and debt, infrastructure and commodities, where funds are perceived to be paying excessive fees to non-aligned intermediaries. What are common strengths among funds like CalSTRS? They identify we have longer time horizons, we can invest with greater scale, we don't have as immediate liquidity requirements, we can develop internal expertise, And to many of our partners, we are what they call socially acceptable to project sponsors. Somebody who's building a bridge over the Sacramento Delta would like to have CalSTRS as their investment partner, as opposed to maybe a private equity house. So that's the idea. They want to create, here's the quote again at the bottom, generalized exchanges bounded by trust and social norms, so that there can be this exchange of resources, information, goods, financial resources through these network relationships, and by that have a better access to private markets at a lower cost. That's the collaborative model as pitched by Stanford Global Center. What I'd like to do, and I've tried to do and have a conversation with you about, is putting this through a fiduciary filter. Because taken as it is stated, this model raises, in my mind, some significant issues with your responsibilities as a fiduciary. When we invest through a limited partnership vehicle, we maintain that exclusivity of responsibility and duty. We put our money into a vehicle. We actually ask our managers to be our fiduciaries and abide by the fiduciary requirements of California law when we go in. And we are making that investment solely on behalf of our members, which is our fiduciary responsibility. The collaborative model, as it's posited in Reframing Finance, says that they'll look to the creation of a bunch of new vehicles. They can be partnerships among peer funds, they can be joint ventures, they can be alliances. And the question that is raised in my mind is, what happens to our exclusive fiduciary duty? Would we end up being fiduciaries to others? Because joint venturers owe fiduciary responsibilities to each other. Partners owe fiduciary responsibilities to each others. That's different from the model that we use now to invest, whether through limited partnerships or co-investment vehicles or managed account vehicles. We are the captain of our ships. We owe fiduciary responsibilities only to our members and not to anybody else. This model would cause an issue relating to whom we owe fiduciary responsibilities. So if you go into a joint venture with another fund, can you say that you now only owe your responsibility to your own members? Would the fiduciary duties we impose today on our private managers in a general partners context be imposed on us by others? Please. Yeah.
So Harvey, I've never thought about being in a fund and the fiduciary component of that. So what I'm hearing you say is that when we invest in a fund with an external manager, that he owes us a fiduciary duty, and he would owe he or she or whatever. The general partner owes a fiduciary duty to everyone in the fund. Is there a fiduciary relationship within the limited partners in the fund?
No,
None at all.
none.
We're fulfilling our fiduciary duty by investing with somebody that owes us a fiduciary duty.
Correct.
when we invest in the markets, there's not a fiduciary responsibility other than the one we owe our members.
That's right.
And so what you're asking us to consider is that if there's just two of us in an arrangement, where that fiduciary duty lies other than the one we already owe our members by being invested. Okay.
Yep. So it's interesting. I get the theory behind it, the academic theory of like-minded investors getting together, but there are some vehicles that would change to whom we owe fiduciary responsibilities. A joint venture, for example. You know, that's a change in the way that we would manage our responsibilities to our fund. And you'll see that in a lot of, in a few other things I'll put on here. I'll fill out the slide. Could we expect other participants in this club, so to speak, to adopt our version of risk factors and ESG policies and all our other investment policies? Would we have to adopt their policies? Would we have an obligation to them to act consistent with their policies? Once you tie together like-minded investors who owe responsibilities to each other, you've changed the fabric of your responsibility as a board and as an investment committee. Because now you take on responsibilities to other investors and they to you. And how do we go about accomplishing that and still be true to our policies?
So we've had a conversation, then if I might follow up with that.
Sure.
I think you've given us a lot to think about. We've been thinking about, we've been interested in the model that, we're interested in learning more about the model that CalPERS is putting together. So they create this entity with its own board. They invest in the board. That switches the fiduciary duty to the board of the entity they've now created, correct?
If you say so.
Well,
Yeah.
they're investing with an external manager. It just
they
happens
own
to be
the
an external
external
manager
manager.
that's them.
It's them, yeah. So that
That's
just
intriguing- that's
attenuates it a little bit more, but I don't
It's
know
an
if it really
interesting-
changes the game.
Thank you.
The last couple of
Excuse me.
bullet points raise some,
Harvey, we
oh,
have
I'm sorry.
One more question. Paul?
Thanks.
So Harvey, you're saying that in the collaborative model, we would be taking on a role that is sort of akin to the general partner in the kind of limited partnerships we currently invest in. And because the general partner in those arrangements has a fiduciary duty to us, we would be taking on a fiduciary duty.
I
that
want to be
correct?
careful to make sure, I'm talking about the collaborative model as posited by
Right, I understand that.
Monk.
But you're,
by Monk.
by
Yeah,
Monk.
not our collaborative
No.
model, and
No,
you'll see
but-
in a few minutes how I distinguish that.
Okay.
Yeah.
But you're suggesting we have a fiduciary duty in his model. Because we play the role that a general partner plays in the traditional general partnerships that we invest in as a limited partner. But I kind of want to back up. I've never thought that the general partners have a fiduciary duty to us, because somebody who has a fiduciary duty puts your interest before theirs. And I don't think that's the way any of these general partnerships work, and I don't think it's the standard to which they're held.
Well, this triggers a conversation about responsibilities on the Investment Advisors Act, under Delaware law, where many of these LPs are formed, and under our contracts. And the responsibility under various schemes is a fiduciary responsibility that the general owes to the limited. Now, in a number of contexts, they, by contract or otherwise, in the LPA agreement, they manage to limit that, or, but my understanding is, and Brian would have to, if Brian were here, he could confirm, you know, what the policy is on our LPAs as to whether we require them to be fiduciaries under the California law. Crystal?
I'm not Brian.
Speaking on behalf of Brian.
Yeah, for the record, Chris Salmon, Chief Investment Officer, not a lawyer. I'm going to say 99.8% of the time we require them to be fiduciaries. I can only require one or two in my entire tenure where that's come up, where they have balked at being a fiduciary. That's just a number one standard we require. The venture capital industry, particularly Silicon Valley, is famous for demanding a section in the limited partner agreement that says they're not a fiduciary and they can actually do things that are in their interest to the detriment of the partnership. And because those funds are so attractive, many people will look past that and sign it. And that started popping up in probably after the internet bubble, before the internet bubble burst, when things were getting really frothy. And that's, I know, when STRS started dropping out, my prior fund started dropping out, because that just went too far. I remember a venture fund that the LPs had to indemnify to the level of gross misconduct. And we just, that's where we were like, we're out. That's ridiculous. So in other words, the GP could literally commit a crime and we couldn't hold them, or defraud the fund and we couldn't hold them hostage for that. So that's, you know, after the staff approves an investment, there's a lot of legal negotiation, and a lot of the answers to your questions depend on the terms and legal conditions. So we'll make a decision to invest on the merits of the GP and the potential of return, but also on the legal standards. And there's a lot of partnerships we walk away from because we just don't like the ILPA. And sometimes those come out to be, I can tell you last year, they were the best performing funds, which just slays us, but I'm glad we're not in them.
Yeah, so that's, I mean, that is, for a fiduciary to delegate investment authority to somebody who's not a fiduciary crosses the chalk
Well,
lines.
but I mean, we're effectively doing that in the terms of these general partnerships then. I mean, we're basically saying, we're defining what their fiduciary duty is to us by the terms of these partnerships,
Well,
which
most of
which
the
have
agreements require them to act consistent with the fiduciary responsibilities that this board acts with. And they have to adopt an understanding that they will act under the
Let's put it this
California
way, Harvey,
Constitution.
if we think that everybody acts as a fiduciary to us, there's no such thing as conflict of interest. There's no such thing as alignment of interests as a problem. So I completely, I just don't, I don't agree with that view. They may be agreeing to act in our interest pursuant to the terms of the agreement. But the terms of the agreement may embody enormous conflicts of interest and misalignment of interests, right?
What they.
I mean, it could,
What they
whether it does or not, but I mean, those are not inconsistent.
Of course,
Okay,
but
okay, so.
what they agree to and what they do may be two very different things.
But that's not what I'm talking about. I'm talking about, I'm saying the agreements themselves can have embodied within them a misalignment of interests.
It's, I wouldn't deny
Okay.
that in
So-
many instances.
I'm
I was
just-
trying to, and I may have it wrong, Paul, your question. I'll take an example of a partnership where the GP is allowed to charge fees and gets the lion's shares of the fees and doesn't have to share any of the LPs. Is that a good example of
Yeah.
where they would, it's a conflict of interest in that they're sharing more? We would perceive that as a conflict of interest, but you're right, under the LP agreement, if you sign the term of that deal,
That's right.
so I can give you a live example of the state of Washington. They signed a deal where the LP got 40% of the profits. The GP got 40% of the profits and they only got 60. When I got there, I felt that was a conflict of interest and unfair, but we had signed it. And therefore, they were still a fiduciary to us.
That's the point I'm making, right.
Right.
But
But it
pursuant to the
was not
terms,
what we would
Yeah,
determine
right.
afterwards as
that's the
a,
point I'm making. Thank
that there
you,
was an
Chris.
inherent conflict of interest, but
Right.
they're
Like-
fiduciary to us even within it.
Like the way in which the Toys R Us arrangement was described, and I know it's more complex perhaps than what we've heard, but I mean, if we had been an investor in that,
Yeah.
and we essentially signed something that said they could walk away with millions of dollars of profits when we lost every cent we invested, but we signed that agreement. As long as they carried that out, they were our fiduciary, right?
Well, that's right.
But
Of course.
it was a terrible, it would be a terribly inconsistent, it would be terribly inconsistent with an alignment of financial interests. So I just want to point out
Yes, that-
that there's a
yeah.
difference there.
In that deal, just so you know, there was a 60-40 fee split. So
Okay.
the LPs did get plenty of money.
Okay.
There is a judgment call that whoever's, the investor is making in all of these situations, balancing the pros and cons of the deal, but not waiving the fiduciary responsibility once the deal terms have been agreed to.
Right.
But you can't expect a fiduciary to behave in a manner that you haven't agreed to.
That I agree. That's,
And so
that's violating the contract.
So, there's some fundamentals about the idea of a joint venture or a partnership, a general partnership, that this model, this academic model, raises. Part of the academic model is to identify, and I think what was brought to CalSTRS was to identify that, listen, you CalSTRS have this currently and are growing a fantastic internal expertise that is essentially marketable. And so instead of other peer funds investing, doing 2 and 20 deals with investment banking houses, you can be the lead on that and create a club type atmosphere with peer funds. And you can be the lead in that and take advantage of capitalizing on that as an asset of the system. And that brings me to the next couple of bullet points at the end of this slide, which is, can we do that? Can we take the asset that we've developed internally for the benefit of our members and essentially lease it out for the benefit? And do we get a price for it? Do we get paid for that? Are we going to give it away? Is that value that we just give away? These are the kind of issues, is that appropriate? Is that a prudent use of the assets of the fund? The asset in this case being the investment we've made in the personnel and the development of our investment division. The other issue, which is the allocation issue that comes to mind, which general partners have all the time. If an opportunity, we've developed a number of opportunities in sourcing these opportunities in the private markets. Which ones do we keep for ourselves? Which ones do we give to the club? How do we make that decision as a fiduciary on behalf of the exclusive interests of our members?
Harvey, to your point about developing expertise in-house and then using that to benefit our partners as well too, I mean, wouldn't you have to look at that as a holistic basis and just say, if we weren't in this partnership, even if we had all this expertise, we still wouldn't have some of the opportunities that now we are afforded because we're banded together? I mean, how would you price
Yeah,
that
well,
out?
I think so. I think you have to look at the whole thing, you know, you would have to ask yourself, what am I getting in exchange for letting others take advantage of the expertise that we've developed? What, does it give me access to bigger projects, for example? Does it give me, I mean, we don't really need that, but, you know, what are we getting in the mix when we're essentially devolving on others the benefit of what we've developed in-house? So it's not necessarily just a quid pro quo, but yes, you're looking at an investment, you have to ask yourself, what are the pluses that we get from using our asset or letting others use that asset that we've developed internally?
And Steve had a question as well, too.
Yeah, Harper, I want to just explore that for a moment. If we were to offer this to, say, other pension funds as part of our club, as you put it, would it be enough that, since we sort of drink from the same well in many respects, that by presumably offering them something of value that they can provide to their members, that would reduce the overall, say, reliance on state general fund contributions, local contributions, whatever it may be, that we are still within the bounds of meeting our fiduciary responsibility?
Yeah, if we can make that nexus, absolutely. That's part of the whole consideration of the circumstances then prevailing. If we're able to reduce our fees and as a consequence reduce contributions or be better funded, absolutely.
So it'd be incumbent on us to draw those parallels.
Yeah. I would
think
want
it's
to
interesting.
see a demonstrated nexus between those factors to
I hear you.
make that work.
Thank you.
A few other things that I should put on the board. Let's just, no. Could we delegate to others in the club? Suppose somebody else brings the in-house expertise in a particular field, in commodities or venture capital, for example. And we haven't developed that expertise, but we we affiliate with another peer fund that has that expertise. Could this board delegate responsibilities to somebody else who doesn't owe the fiduciary responsibility to the same people we do? Is that prudent? What due diligence would we have to engage in to satisfy ourselves that they have the expertise that is appropriate under the circumstances? Would we allow them to conduct due diligence on us? This is more of an operational side, but again, it heightens the issue about to whom do you owe your responsibility? Confidentiality requirements are raised. There's a lot in the Monk publication and theory that says, you know, hard contracts are just so yesterday. We can have relational contracts. I'm not sure what relational contracts are or how you enforce them, but this theme underlines that there's going to be this trust and comity among all these peer funds so that we can cut out the middleman and access markets somehow. To me, it's a bit pie in the sky, but it does raise some issues about what is prudent under the circumstances for managing the assets of the fund. That raises the issue about whether or not we would have to have a whole bunch of new governance structures to manage this process, as they posit in their publications. It would be unlikely that we could continue to manage the investment process the same way if this became prevalent in our portfolio. And the final point I would make is, and I think we've alluded to this, is there are situations where taking on ownership and control of portfolio companies, for example, if we were the lead investor and we took control of portfolio companies in the private equity side of our portfolio, could we be creating liabilities for the system where right now we're protected as limited partners, as going through other vehicles? We don't expose ourselves to liability for underlying issues that arise with the portfolio holdings of our partnerships. This might expose us to that kind of liability. So,
Excuse me, I'm sorry, we have one more question.
yeah.
Paul?
I'm just wondering how you interpret the arrangements that we have done in the infrastructure and the inflation-sensitive area. For example, the Argo arrangement.
I'm not familiar with it.
Okay.
I'm
Does
sorry.
maybe Scott's got some thoughts on that, because that seems to sort of move into some of the areas of concern that you're raising.
Yeah, maybe I'll just make a comment to clarify a little bit, because I think there are differences between what Harvey is presenting, which is Ashby Monk's proposals,
Right.
and what we've been describing as the CalSTRS collaborative model. So I'll make a few comments there, and
Next
Chris.
slide.
Oh, that's your next slide? Okay.
Exactly.
Well, it seems like a good juncture maybe to
Please.
chat a little bit about it right now. So I think if you recall some of the collaborative model presentations we've been presenting, we've showed the gradation of taking more and more assets in-house, right? And Harvey's talking about a specific case where we would get together with a peer, and with nobody in the middle, not even hiring a management team, we would both invest directly in an asset, right? And so that's on the very end of the scale that we've been describing to you. But as you know, we think during our private equity presentation, for example, there's a lot of quote-unquote low-hanging fruit for us to just take in-house a lot more co-investing, right? And our fiduciary responsibility isn't changing from that perspective, right? So I think we're always fiduciaries, but the fiduciary responsibility that we have is going to change depending on the vehicle. And as I think Paul made a good point in alluding to the fact that it's not only the fiduciary duty, but the conflicts of interest and alignment that we want to alter as well in a lot of these models, where we gain more control over the risk and better alignment. Right? So and Lynn made a good comment as well in terms of looking at it holistically. What's the return potential in terms of the types of deals we can source? So I just wanted to clarify some of those points that what we've been talking about is using all of those tools, but it's very unlikely, and I don't think we're in a position where we would be doing the things that Harvey has been talking about.
I'll just add, there is nothing that gets a wet signature from me or from Scott that has not already had an original signature from one of our lawyers in the team behind you. So he's raising challenges and issues, which I'm counting on them to look at and alert me if there's one that's even close to line. And to answer your question, Paul, on Argo, because I realize Scott probably hasn't had a chance to know Argo very well. Argo was a infrastructure investment opportunity that we basically created with APG, the Dutch fund. But neither us nor APG own the company. Basically what we did is seed a new team. We're their only capital, but that gave us a chance to negotiate their budget and their fees. They're now at the point where they want to take on other clients, and we did a partnership 1, and now we did partnership 2. Now they want to take on other separate accounts for other people, and we've both said, okay, go ahead. And if they do, then it lowers the budget for our fees. So we get back to your point of, do we get some value add for having been that initial capital to put them in business? And we negotiated that in that, yes, we do if they continue to grow.
So
And then obviously we have the chance to walk away if we don't like their next, they're not partnerships, they're separate accounts, so we can always walk away.
So we have a little more control, we have a little more say, we have some influence over the fees, but we don't have in any respect the fiduciary duty to APG?
We do not have a fiduciary duty to APG or their members. We only have a partnership agreement and a working relationship. And some, I'll give you a live example of what Harvey is talking about, because I've been banging my head against this for a year and a half now. We're in open session, aren't we?
Yes.
I don't think I want to talk about that anymore. But there's a plan in some other country that we are very impressed with and think quite highly about. And we'd love to team up with them, except their law only requires them to be a fiduciary to their members. And I can't and won't hire them unless they'll be a fiduciary to us. But we'd love to team up with them because we think they're very, very good and they like us. And that's what's held us back. We cannot figure out the legal structure to make this darn thing work properly, to form together. But, it's literally their laws are written appropriately for them, so.